For most people, a recession feels like a sudden storm, an unexpected collapse that seems to appear out of nowhere. One week, the economy is booming. Businesses are hiring, markets are rising, and everyone feels as if the future is finally within their control. And then, slowly at first, the cracks begin to show. Prices rise, jobs disappear, banks tighten, markets tremble, and what once felt stable begins to fall apart piece by piece, until millions are left wondering how everything changed so fast. But what if recessions aren't natural disasters? What if they aren't sudden at all? What if the collapse is not an accident, but the result of deliberate decisions made behind closed doors? For centuries, nations have blamed recessions on market cycles, corporate greed, or miscalculated policies. But deep inside the global financial system lies a network of deals, negotiations, and silent agreements, so powerful that they can shift the direction of entire economies. These aren't the official meetings you see on television, nor the press conferences where leaders pretend to explain what happened and why. These are hidden discussions, quiet deals struck between governments, central banks, mega corporations, and financial institutions that operate far above the reach of ordinary citizens. And once you understand how these dark financial agreements work, you will never see a recession the same way again. Every major economic collapse in the last 100 years, every panic, every downturn, every crisis, has been influenced not by chance, but by the same recurring pattern, a pattern that begins long before the public ever feels the impact. It begins with debt, with interest, with risk, and with a handful of powerful entities deciding how much money should be created, how much should be destroyed, and who should benefit each time the world is plunged into financial chaos. Imagine a room, not a grand hall filled with politicians, but a quiet, dimly lit space where a few individuals sit around a small table. No cameras, no journalists, no public observers. Only decision makers, representatives of central banks, heads of private financial institutions, and a select few government officials. Their task is simple: protect their interests no matter the cost. In this room, entire economies are shaped not by votes or public debate, but by negotiations about liquidity, credit lines, interest rates, and bailouts. And when these negotiations go wrong, or when someone in the room wants them to go wrong, the result is a recession. The 2008 financial crisis, for example, is remembered as a disaster caused by reckless banks and risky mortgages. But in the years before the collapse, powerful financial institutions had already begun quietly selling off their toxic assets. They sensed what was coming. They prepared. They protected themselves. Meanwhile, the public remained unaware, investing in markets, buying homes, and taking loans, never realizing that the system had already been set on a trajectory toward collapse. But here's the darkest part. Many institutions didn't just predict the recession. They positioned themselves to profit from it. They created financial instruments designed to bet against the very markets they were promoting. They encouraged ordinary people to invest in assets that they knew were rotting from the inside. And when the collapse came, they cashed out, walked away, and left millions to suffer the consequences. This is not an isolated story. This pattern has repeated itself time and time again. In the 1997 Asian financial crisis, international investors quietly withdrew billions from Asian markets months before the collapse. Currency traders made massive bets against regional currencies, pushing them into a downward spiral. And when the economies fell apart, powerful institutions swooped in to buy assets at a fraction of their value. In the 1929 Great Depression, the same thing happened. Wealthy insiders sold stocks long before the crash. They attended private luncheons where warnings were whispered, sometimes between courses, about the dangers lurking beneath the market. When the crash hit, they were already safe, sitting on piles of cash while ordinary families lost their savings, their homes, and in many cases their hope. Even more chilling is the fact that governments have been part of these deals for decades. When a recession becomes unavoidable, or useful leaders coordinate with central banks to decide who will be rescued and who will be sacrificed. Corporations that play along receive bailouts, financial support, or special privileges. Those that don't, they collapse. And behind every bailout are hidden conditions, contracts, and obligations that give governments and institutions power over industries, resources, and markets. Every crisis is an opportunity not for the public, but for those who understand how to turn collapse into control. Take the era after World War II. Many believe the economic rise of certain nations was due to innovation and hard work. But historians now reveal a different truth. Powerful countries made secret financial arrangements that determined which nations would rebuild quickly and which would remain economically dependent for decades. Loans were given with conditions. Aid was distributed strategically. Banks were instructed to support specific investments while denying others. And these decisions shaped the global economy for generations. In the modern era, something even more concerning has emerged: the rise of shadow banking. These are financial institutions that operate outside of traditional regulation, entities with trillions of dollars under management, invisible to the public and barely understood even by governments. When they move money, entire markets shift. When they change strategy, currencies rise and fall. And when they influence central banks, the consequences ripple across the world. Many of these shadow institutions have direct influence over recession timing. They pressure policymakers. They manipulate credit availability. They create artificial booms by flooding markets with cash, and then trigger collapses by pulling that cash out instantly. Every time this happens, everyday people pay the price. Recessions also serve as a reset mechanism. When wealth becomes too distributed, when wages begin to rise too much, or when average citizens start gaining too much financial independence, systems begin to tighten. Interest rates rise. Loans become harder to get. Markets become unstable. Suddenly, the public is pushed back into survival mode. Savings are drained. Businesses close. Jobs disappear. And wealth flows upward, into the hands of those who know how to navigate the chaos. This isn't an accident. It is a pattern, a deliberate cycle designed to maintain control. If you look closely, you'll see that before every major recession, the same signs appear. Risky lending increases, markets become inflated, debt reaches unsustainable levels, and powerful institutions quietly begin to shift their assets. These shifts are the smoke before the fire. And yet, every time the public is blindsided. Why? Because the truth is hidden behind technical language, complicated charts, and political speeches that mean nothing. Leaders say, "We didn't see it coming." But in private, they prepare months or even years in advance. They negotiate deals with banks, secure emergency funding, and arrange interventions that protect the powerful long before the collapse reaches ordinary people. Sometimes recessions are even strategically timed. Elections, geopolitical tensions, global disputes over trade or resources, all of these can influence whether financial leaders allow a recession to happen now or later. In some cases, a recession becomes a tool, a way to weaken a rival nation, shift global power, or create political opportunities. And in every case, someone benefits. Often the very people who caused the crisis in the first place. But the darkest truth is this: recessions have become part of the system's design. They are not deviations, they are features. They clean the slate, erase competition, consolidate wealth, and reinforce the hierarchy that keeps a small group at the top. Each recession is followed by the same pattern. The rich buy assets cheaply, markets stabilize, confidence returns, and the cycle begins anew, until the next collapse. Even today, you can see the warning signs. Prices are rising. Debt levels are higher than ever. Income inequality is reaching breaking points. Currencies are weakening, and quiet meetings are happening. Behind closed doors, meetings that will never be shown on television or mentioned in public speeches. These discussions determine the next phase of the global economy. They decide which industries will be protected, which nations will struggle, and which financial institutions will grow more powerful when the next recession hits. Because it will hit. The question is not if, but when, and who will gain from the chaos. The next recession is already forming. Money is being moved. Assets are being transferred. Investments are being repositioned. The world is being prepared, quietly, for another collapse. And just like before, the public will be told it was unpredictable, unforeseen, unavoidable. But now you know the truth. Recessions are engineered by the deals, made in the shadows. Deals that shape the fate of nations, influence the lives of billions, and ensure that power remains in the hands of the few. The storm is coming, and the people who created it are already safe. The real question is, will you be one of the millions left in the dark, or one of the few who finally understands how the system really works?